right? So we'll see the tutorial number 4. Last time we have studied this tutorial, right? So you can start with the worksheet. You can start with this worksheet. Right. So last time we have designed this worksheet. So each year we have 3 columns. For each year we have 3 columns. The values before adjustment, those are the values as given in your financial statements. Then another column for adjustments. Then you get the adjusted values. Right. So we have designed this worksheet last time. Now let's see additional information number 1. In your tutorial, additional information number 1. Now you see, on 1st April 2019, so that is in 2019-20 year. 2019-20 year. So here 2020 year. So on 1st April, company obtained vehicle on following lease terms. Now you see, the company has got a motor vehicle on lease terms. You see the lease terms. Annual rental is 416, payable on 31st March. Interest rate implicit in the lease 12%. Estimated useful life is 6 years. But lease period is 5 years. You see, you have to pay 5 annual lease rentals of 416,000. So lease period is 5 years. So lease payments have been classified in the financial statements as operating expense. So this is not acceptable. This accounting is not acceptable. So you have to account the lease according to IFRS 16. Right, you know this, IFRS 16. Right, now we need to adjust financial statements because the lease payments you have charged to the profit. If you see additional information number 6, you see additional information number 6 under finance cost, sorry, under administrative expenses, you see lease rental paid. Lease rental paid. So lease rental paid. Now you see under administrative expenses. The meaning is company has charged lease rental to profit and loss account. Company has charged lease rental to profit and loss account. So this adjustment is not acceptable. This accounting is not acceptable. Now you need to adjust financial statements. Right. Now you see, you started the lease on 1st April 2019. So your lease is affected by 2020 and 2021 years. So lease is affected by both years. So you have to adjust 2020 year and 2021 year. Now we'll first adjust 2020 year, 2020 year, right? So we can have a separate, or in this worksheet, somewhere down you can have workings. You can have workings. After the financial statements, you can have workings. Right. So working number one. Working number one. Adjustment for lease. Adjustment for lease. Working number one, adjustment for lease. Right. Now we need to adjust 2020 and 2021. Now for the adjustment, we have to prepare the amortization schedule. Amortization schedule. Right. Lease amortization schedule. Year. Beginning balance. Interest. Then lease installment. Then capital repayment. Capital repayment. Then balance at the end. End balance. End balance. So lease start from 2020 year. Your lease start from 2020 year. Then how much beginning balance? Beginning balance equal to the present value of lease rental. You see a lease rental is, you see the question? Lease rental is 416,115. So you have to pay annually for a period of 5 years. Interest rate 12%. So 416,115 for a period of 5 years. So we'll take the present value. So you are paying lease rental for a period of 5 years. 416,115. Interest rate is 12%. Interest rate is 12%. You see the question? Interest rate is 12%. Right. So you can calculate the present value of this lease rental. So you can apply in PV function. The rate is 12%. And these are the cash flows. Right. Now you see a present value of this lease rental, 1.5 million. This is present value of lease rental. Present value of lease rental, 1.5 million. Right. So 1.5 million. So beginning balance is equal to 1.5 million. Beginning balance is equal to 1.5 million. Right. Then interest. Interest 1.5 million beginning balance into 12%. Installment is 416,115. Now you see out of 416,115, interest component is 180,000. Then 416,115 minus interest, you get the capital repayment. Capital repayment. Then beginning balance minus capital repayment, you get the end balance. Beginning balance minus capital repayment, you get end balance. Right. So we'll continue this for 2021. 2021 beginning balance 1,263,885. Interest 12% of the beginning balance. Installment same. Then capital repayment equal to installment minus interest payment. Installment minus interest payment. Then end balance, beginning balance minus capital repayment. You get the end balance. So similarly for 2020, 2022, beginning balance is 999,436. Interest, installment same. Then capital repayment 296,183. Right. So we need this amortization schedule to do the adjustments. Right. Now we'll do the adjustment. Now this lease rental company has charged to the profit. So that's wrong. So you have to remove that adjustment. Company has taken this installment to profit, right? Now the amount charged to the profit is in administrative expense. So you need to remove this adjustment, right? So in 2020, from administrative expense, you have to deduct 416 in thousands, 416. 416. So you have to deduct 416 from administrative expenses. You have to deduct 416. Right. So this is a lease rental. Then the adjusted value 1875. Adjusted value 1875. Right. Now you need to take the lease adjustments. You see, first year interest 180,000. You have to take interest to profit and loss. You see, first year interest 180,000. You take interest to profit and loss. Under finance costs. So finance cost increases by interest amount 180,000. Finance cost increases by interest amount 180,000. Then the adjusted finance cost. 234,000. Adjusted finance cost 234,000. In thousands, 234. Before adjustment 54. So finance cost increases by 180. Then the adjusted value 234. 234. Right. Now we have brought the interest. Then you need to bring the end balance. Now you see 2020 end balance 1,263,000. In thousands, 1,263 or 64. You need to separate this end balance into current and non-current proportions. So how much current proportion? The capital repayment in the next year. Current proportion is capital repayment in the next year. So your current liability, 2020 end, current liability, 264. In thousands, 264. So under current liabilities, you can add another column, another row. You can add another row. You can say current proportion of current proportion of lease liability or lease creditors. Current proportion of lease creditors 2020 264. 264. Amount before adjustment 0. then adjustment 264, then adjusted value 264. Then the balance is non-current liability. Under non-current liabilities, you can add another row. You can say lease creditors. Lease creditors. Amount before adjustment 0. So how much adjustment here? You see total lease creditors in thousands, 1,264. Out of that, 264 is current proportion. Then the non-current proportion, the balance 1,000. So you see total lease creditors 1,264. Out of that, 264 is current proportion, current liability. The balance 1,000 is non-current liability. Then the adjusted value, amount before adjustment 0 plus adjustment, you get the adjusted value. Adjusted value. Right. Now you see we have brought the interest. We have adjusted interest. We have brought the two liabilities. Now you have to record the asset under non-current assets. So it's motor vehicle that comes under property, plant and equipment. How much asset value? Equal to the beginning lease balance, 1.5 million. So you have to depreciate the asset over 5 years. Then how much depreciation? Depreciation equal 1.5 million divided by 5. Depreciation is 300,000. 300,000. So depreciation goes to profit and loss. You can take under administrative expenses. So under administrative expenses, you can take depreciation. You can take depreciation. Right. So depreciation, $300. So your administrative expenses increases by 300. Administrative expenses increases by 300. Then it's the value is 2,175. 2,175. Right. Now you see we have adjusted lease rental. So you have deducted lease rental from the administrative expenses. 416 is lease installment, lease rent. And this 300 is depreciation. 300 is depreciation. Now you see 2,291. You deduct lease rental 416 plus depreciation. The adjusted value 2,175. Adjusted value 2,175. Then asset value, the cost of the value of the asset at the beginning 1,500 in thousands minus depreciation 300. Then the asset value is 1,200. So that's added to the property, plant and equipment. That's added to the property, plant and equipment. Then the property, plant and equipment adjusted value 6,996. 6,996. Right. Now, this is how you adjust. Similarly, you have to complete 2021. You have to adjust 2021. Now, lease rental is already included in administrative expenses. You deduct rent from administrative expenses for 2021. You deduct rent from administrative expenses and add depreciation. Add depreciation. Then how much adjusted value? 2,364 minus lease rental plus depreciation. 2,364 minus lease rental plus depreciation. You get the adjusted administrative expenses. Then to the finance costs, you need to bring the interest, lease interest. How much lease rent interest for 2021? You see interest for 2021 in thousands, 152. Interest in thousands, 152. That goes to finance cost. Lease interest. 152. So you have to add to the finance cost. You have to add to the finance cost. Then finance cost increases to 901. Finance cost increases to 901. Then you have to record the asset. At the beginning of year 2021, asset value 1,200. Then 1,200 minus depreciation 300. Then asset value comes to 900. So 900 is added to the property, plant and equipment. 900 is added to the property, plant and equipment. Now you see we have recorded the interest, depreciation, and we have recorded the asset. Then you have to record the lease liability. You have to record the lease liability. So you have to find out how much current proportion of the lease and how much non-current proportion. Now you see the amortization schedule. So at the end of year 2021, you see, at the end of year 2021, the total lease liability is 999,436. Right. So in thousands, it's almost 1,000. Then how much current proportion? The current proportion is next year capital repayment. So next year capital repayment, 296. So 296 is next year capital repayment. So under current liabilities, 296, then the adjusted value 296, then out of 1,000, 296 is current liability. The balance 1,000 minus 296, the balance 704 is non-current liability. Balance 704 is non-current liability. Right. So if you have any question, you can ask. Right. So you have come with the answer. Now you need to just check your answers. Right. So during these 2 hours, you need to check your answers. So if you have any question, you can ask. Right. Now we have adjusted for the lease. So later we'll adjust the tax effect. Later we'll adjust the tax effect. Right. So let's see number 2. Number 2. On 1st April 2020. So this is beginning of 2020-21 year. On 1st April 2020, the company issued 500 nominal value of debentures for 5 million nominal value of debentures for 5,250,000. These debentures mature in 5 years. Premium has been recorded under reserves. Interest paid annually at the rate of 14%. Right. Now you see in your financial statements, you have recorded the nominal value under non-current liabilities and the premium 250 you have recorded under equity. So this is wrong. According to IFRS 9, you have to record the debenture at amortized cost. You have to record the debenture at amortized cost. Right. Amortized cost is equal to the present value of future cash flows. Now you find the amortized cost. You can have working number 2. You can have working number 2. Adjustment for debenture. Working number 2. Adjustment for debenture. Now to find the amortized cost, you have to find the effective interest rate. You have to find the effective interest rate. We studied last time. Right. We studied. Now debenture mature in 5 years. So you see the debenture cash flows. You see the debenture cash flows. So today we'll take in thousands. Today you you receive the issue price because the company issues debenture. Right. So you issue debentures at 5,250,000. So company receives the issue price. Then over the debenture period, company has to pay interest. At the maturity, company has to repay the nominal value. You see the interest rate. You see the interest rate, 14%. Interests are paid annually at the end of the year. Nominal value of debentures, 5 million. Now calculate the interest. Calculate the interest value. How much interest? For coupon payments. Coupon equal nominal value multiplied by coupon rate. Nominal value multiplied by coupon rate. So 5,000 multiplied by coupon rate, 14%. Now you see coupon is 700. Coupon is 700. So first year company has to pay 700. Second year company has to pay 700. So likewise, all 5 years, company has to pay 700. So these are coupon payments. Coupon payments. At the maturity, at the end of the 5th year, company has to pay par value. Therefore, in the 5th year, the total payment is coupon plus par value, 5,700. The total payment is 5,700. Coupon plus par value. Right. Now these are debenture cash flows. You have to find the effective interest rate. You have to find the effective interest rate. Right. So using these cash flows, You have to find the effective interest rate. So that's IRR. You can apply IRR function. So you select these values. You select these values. So you get IRR 13%. IRR 13%. Or 12.6%. 12.6%. So this is effective interest rate. So according to IFRS 9, you have to calculate the debenture value, debenture liability at amortized cost. But to calculate the amortized cost, you need the effective interest rate. You need the effective interest rate. Right. Now we'll prepare or we'll calculate amortized cost. Now we know the effective interest rate. So beginning balance, interest for the year, amount paid, payment, then end balance. End balance. So the issue price is beginning balance 5,250. Interest equal beginning balance multiplied by effective interest rate. Beginning balance multiplied by effective interest rate. So interest is 661. In the first year, you have paid 700 coupon, payment 700. Then end balance, beginning balance plus interest minus payment. You get the end balance 5,211. So this is debenture liability at amortized cost. This is debenture liability at amortized cost. So that goes to a statement of financial position. In the statement of financial position, the debenture liability 5,211. 5,211. Right. So at the end of 2021, debenture liability should be 5,211. Debenture liability should be 5,211. So adjusted value, debenture liability 5,211. So you have to remove the premium. You have to remove the premium. Then adjusted value 0. You have to remove the debenture premium because you record the debenture at amortized cost. If you record the debenture liability at nominal value, then the premium comes. But we don't record the debenture liability at nominal value. We record the debenture liability at amortized cost, 5,211. Then there should not be any premium. So you have to remove the premium from the accounts. Then you see interest, 661. You see interest, 661. So this 661 goes to profit and loss. So 2021, under finance cost, we have another adjustment, debenture interest, 661. You see debenture interest, 661. Then the adjusted finance cost. So you need to add 661. So finance cost increases by 661. Adjusted finance cost, 1,562. You see additional information number. You see in your question, additional information number 6, finance cost. You see finance cost included debenture interest, 700. So this is wrong. Interest should be 661. 661. So you remove this 700 and add 661. So you should remove this 700 because we have added the correct interest. We have added the correct interest, 661. Therefore, you remove 700 from finance cost. So deduct 700 from finance cost. Deduct 700 from finance cost. So finance cost adjusted value, 862. Finance cost adjusted value, 862. Right. So we'll see again this. You see in the additional information, company charge debenture interest 700. But the interest should be charged to profit is 661. So you remove 700 from the accounts and add 661. Remove 700 and add 661. Any question? Any question? Right. So these are the adjustments related to debentures. So you brought the debenture value and you brought the interest. Then we have removed the interest charged to the profit and loss. Right. Then let's see number 3. Let's see number 3. The company obtained a bank loan of 400,000 on 1st April 2018 on the following terms. Grace period was 12 months. Thereafter, repayments are annual at 100,000 plus interest for a period of 4 years. The repayments commence on 31st March 2020. The repayments commence on 31st March 2020. The interest rate of the bank loan 12%. Interest rate of the bank loan 12%. You remove the word implicit. So just bank loan interest rate. You remove the word implicit. You know, implicit interest rate comes with the lease. Implicit interest rate comes with the lease. Therefore, here it's just bank loan interest rate. Now, again, this is a long-term liability. So you have to record that amortized cost. You have to record that amortized cost. I will calculate the bank loan liability at amortized cost. Then we'll see whether the company has recorded accordingly. Right. Now let's see. We'll move on to another working. Working number 3. Working number 3. Adjustment for bank loan. Adjustment for bank loan. Right. So you have to prepare amortization schedule, because bank loan has to be recorded at amortized cost. Bank loan has to be recorded at amortized cost. Now we'll see the question again. We'll see the question again. You got the bank loan in 1st April 2018. So that is year 2018-19. But first year is a grace period. So during the first year, you don't have to pay anything. Thereafter, you see repayments are 100,000 plus interest. From the second year onwards, 2020 onwards, repayments are 100,000 plus interest. So this is for 4 years. You see, repayments commence on 31st March 2020. Interest rate 12%. Interest rate 12%. Right. Now let's prepare amortization schedule. Amortization schedule. Here, beginning balance, interest, then capital repayment, or we get the total repayment, installment, then let's see capital repayment, then end balance, end balance. Right. Now you see we got the loan in 2019, but first year there is no repayment. Right. First year there is no repayment. The repayment start from the second year. Repayment start from the second year. Right. You know, the liability should be present value of cash flows. So every time, whether it's bank loan, whether it's a lease or debentures, the liability should be present value of cash flows. Liability should be present value of cash flows. Right. So we'll find the liability. We'll see the cash flows. Here cash flows. You got the loan 2019. You received the loan on 1st April 2018. 400. So we'll calculate in thousands. You received the loan on 1st April 2018. 400. 2019 year, there is no repayment. The repayment start from the second year onwards. Repayment start from the second year onwards. So that goes for 4 years. From second year onwards, repayment goes for 4 years. Right, 4 years. Now how much second year repayment? How much second year repayment? 100,000 plus interest. 100 plus interest. How much interest? Loan balance is 400 multiplied by loan balance is 400 multiplied by interest at 12%. Interest rate is 12%. So second year repayment, 100 is capital repayment plus interest. Capital repayment plus interest. How much? Repayment 100 plus loan balance multiplied by interest rate 148. 148. Right. So second year repayment 148. Third year repayment again 100 plus loan balance when it comes to the third year 300. Because from 400 you pay capital repayment 300. Then loan balance from 400 you pay capital repayment 100. Then loan balance is 300 multiplied by 12%. Multiplied by 12%. How much? 136. Third year cash flow 136. Then fourth year cash flow 100 plus 100 plus. When it comes to the fourth year, loan balance is 200 multiplied by interest rate. Then the repayment 124. Then in the last year, 100 plus loan balance 100 multiplied by 12%. 112. Now these are the loan cash flows. First year there is no payment. You see, question says company received a grace period. Then repayments are from next year onwards, second year onwards. So these are the repayments now. 100 plus 100,000 plus interest. 100,000 plus interest. Now you can calculate the effective interest rate. You can calculate the effective interest rate. So effective interest rate equal, you can apply IRR function. You can apply IRR function. Right, IRR. Then you select these cash flows. You can apply IRR function. You see effective interest rate 8%. 8.2%. Effective interest rate 8.2%. So remember, every time, whether it's bank loan, lease, or debenture liability, so all should be recorded at amortized cost. For that, you have to find the effective interest rate. So if you know the cash flows, you can calculate IRR. So that's effective interest rate. Right. Now you can calculate this loan balance at amortized cost because we know the effective interest rate. Right. So what you can do is you can prepare this amortization schedule. Here, beginning balance, interest, will take the end balance. Sorry, beginning balance, interest, then payments, cash flow, payment, then we have end balance. Right. So we need only these columns. Beginning balance, interest, then the payments, end balance. Right. So loan started in 2019. That goes up to 2023. You see, loan started in 2019. Goes up to 2023. 2020, 21, 22, and 23. So beginning balance is 400. Beginning loan balance is 400. Interest equal beginning balance multiplied by effective interest rate. Beginning balance multiplied by effective interest rate. So you can fix this value. You can put dollar marks. So select the cell number, then press F4. So interest. So we'll round up this value. We'll round up this value. $33. 2019 interest, 33. Then 2019, there is no payment. End balance, beginning balance plus interest minus payment. End balance. Then 2020 beginning balance, 433. So interest equal beginning balance multiplied by effective interest rate, you get 35. Payments we have calculated. You see 2020 payments, 21, 22, 23. So these are the payments we have calculated. You can copy these values. You can copy these values. Then end balance, beginning balance plus interest minus payment. You see end balance 320. End balance 320. Right. So likewise, you can complete the table. You see at the end of the loan period, the balance comes to 0. At the end of the loan period, you see a balance comes to 0. Balance comes to 0. Any question? Right. Now using this amortization schedule, we can record the loan payments. We can record this bank loan. So 2019 end balance should be 433. 2019 loan balance should be 433. Should be 433. So in your statement of financial position, 2019 bank loan should be 433. So bank loan balance should be 433. But out of that 433, 100 has to be paid within the next year. Therefore, 100 is current liability. You see current proportion of the bank loan, 100. The total bank loan liability 433. Out of that 100 has to be paid within the next year. So current liability should be 100. Then non-current liability only 333. Non-current liability is only 333. Right. So adjusted value 333. So we got this adjusted value from that amortization schedule. So non-current liability of the bank loan should be 333. So you see again, by the end of 2019, you see bank loan balance 433. Out of that 100 has to be paid within the next year. You know each year you pay the bank loan 100,000 plus interest. So 100,000 is capital repayment. So out of 433, 100 has to be paid within the next year. Therefore, 100 is current liability. Then the balance 333 is non-current liability. Right. Now we have adjusted bank loan liability for 2019. Then how about 2020? You see 2020 end balance. You see 2020 bank loan end balance 320. Out of 320, 100 has to be paid within the next year. Then out of 320, 100 is current liability. Balance 220 is non-current liability. So bank loan liability end of year 2020, the adjusted liability should be 220 under non-current liabilities. Then 100 is current liability. 100 is current liability. Then 2021, you see bank loan end balance 210. So out of that, 100 has to be paid within the next year. So 100 is current liability. Balance 110 is non-current liability. Now you see 2021 financial statement. Under non-current liability bank loan 110. Under non-current liability bank loan 110. Then the current proportion of the bank loan is 100. Current proportion of the bank loan is 100. Right. Any question? Now you see, before the analysis, we should adjust our financial statement to appropriate values. So you check the financial statements. Now you see some liabilities are not recorded at the appropriate values. Now you need to adjust. Right. Now we have adjusted the bank loan liability. Bank loan liability. Then we'll adjust the interest. Now these are the interest. These are the interest amounts that should be in the profit and loss account. 2019, the interest should be 33. 2020, interest of the bank loan should be 35. 2021, interest of the bank loan is 26. So these are the interest amount that should be in your profit and loss account or statement of income. 33, 35, 26. 2019, 33. 2020, 35. And 2021, 26. Now you see how much you have already charged. You see interest on bank loan, nothing charged in 2019, 48 charged to 2020, and 36 charged to 2021. You see, there is no interest charged to 2019, 48 charged to 2020, and 36 company has charged to 2021. Now you see these values are wrong. You see these values are wrong. So you have to adjust the interest amount. So we'll adjust 2019, nothing charged to profit and loss account. But according to your calculation, 2019 interest on bank loan 33. Interest on bank loan 33. So you need to add 33. You need to add 33. 2019 under finance cost. Under finance cost 2019. So you have to take bank loan interest. Under finance cost 2019. You have to take bank loan interest. Bank loan interest 33. So 8 plus 33. 8 plus 33. You get 41. 8 plus 33, you get 41. Right. So this is a 2019 adjustment. You see 2020. Company charge 48. You see company charge 48. But according to your calculations, 2020 interest should be 35. 2020 interest should be 35. So you remove 48 and take this 35. From the finance cost, you remove 48 and take this 35. So 2020, from the finance cost, you remove this 48 and take 35. Right. So this 118 2020, you see under finance cost, this 180 is lease interest. This 180 is lease interest. Then we have for bank loan, remove 48 and add 35. So this adjustment for bank loan. This adjustment for bank loan. You remove 48 and add 35. So from 234 adjusted value, you remove 48 and add 35. So you get 221. You get 221. Right. So this is for 2020. So let's see 2021. You see company charge 36. But according to your calculation, interest should be 26. So company charge 36. But the interest amount should be 26. So you remove 36 for 2021. For 2021, for bank loan, the adjustment is remove 36 and add 26. So this is adjustment. For bank loan, the amount already charged to finance cost, you should remove and take the correct value, correct interest. So plus 36 minus 26, the correct value should be 852. The adjusted interest, adjusted finance cost, 852. Any question? Now you see additional information, number 1 about lease, number 2 about debentures, number 3 about bank loan. You see all three liabilities, all these three liabilities, you should record at amortized cost. Then number 4, you see company guaranteed import loans obtained by ABC company by 31st March 2021. ABC become bankrupt and unable to settle the import loans. So now you are liable to pay this 500,000. So this should be your liability. Right. Now you see the financial statement. See where the company has recorded this 500 liability. So this should be under current liabilities. Now you see company has not recorded this. Now you see there's an unrecorded liability. So you insert a row, you can record this liability. Payables, payable for guarantee. Payable for the guarantee. Recorded amount 0. So you are liable to pay 500. Then adjusted value is 500. Adjusted value should be 500. Right. So 2021. So guarantee payable is 500. And this is a expense. Right. So this is your loss. Then this should be taken to the profit and loss. So you can take as other expense. You can take as other expense. So you can insert a row in your income statement. Then you can write down other expenses. Other expenses. So you need to adjust for guarantee liability. Guarantee payable 500. So adjusted expense is 500. Adjusted expense is 500. Right. Adjusted expense is 500. Any question? So you have guaranteed another company's loans. Now that company is unable to repay the loan. Then you are liable to repay the loan. So that ABC company is unable to repay the loan. As a result, you are liable to repay the loan. So this is your loss. This is your loss. Right. Now we can move on to the last one. Number 5. You see, during the year 2021, company changed the depreciation from reducing balance to straight line basis. the amount of depreciation that would have been charged if the new method were applied for 2019 and 20 was 190,671, 198,210. Now you see earlier company was following reducing balance method. In 2021, company experienced that straight line is more appropriate. Now you see this is change of accounting policy. This is change of accounting policy. Now you should apply the new methods to all 3 years. So new method is straight line basis. So this has been applied to 2021. Now you have to adjust 2019 and 2020 financial year. So if the new method applied to 2019, how much depreciation? In thousands, 191. So if the new method applied to 2019, the depreciation should be in thousands, 191. But company charge how much? You see under administrative expenses, 205. Company charge 205. But if the new method applied to 2019, the depreciation should be 191. 191. Then how much over depreciation? So that over depreciation you have to adjust. So we'll come to a working now. Working number 4. Working number 4. Adjustment for depreciation. Working number 4. Adjustment for depreciation. Now you see 2019, company was following reducing balance basis. 2020, company was following reducing balance basis. But 2021, company changed the depreciation method to straight line basis. Now you see these 3 years are now not comparable. Company changed the depreciation estimation. This is change of accounting estimates. Now you see these 3 years are not comparable. Because 2 years company was following straight reducing balance, and 2021 company moved to a straight line basis. You see, these 3 years are not comparable. So what you have to do is you have to adjust the depreciation for the last 2 years you have to adjust depreciation to straight line basis. You see, last 2 years, depreciation is at reducing balance basis. So you need to adjust last 2 years depreciation to straight line basis. So you take depreciation already charged, depreciation already charged. How much? Depreciation already charged. You see the question. You see the question. 2019, 205. 2020, 211. Depreciation already charged, 205 and 211. You compare this with depreciation on straight line basis. You compare with depreciation on straight line basis. You see the question. If the straight line basis apply, if the new method were applied, 2019 depreciation is 191. 2020 depreciation is 198. So depreciation according to the new method, 191, 198, 191, 198. Then how much over depreciation? How much over depreciation? So 2019 amount charged to the profit 205, but depreciation according to the straight line basis 191. You see over depreciation is 14. 2020 over depreciation is 13. Now you need to adjust your expenses. 2019 you need to adjust over depreciation 14. 2020 over depreciation 13. You see the financial statement, administrative expenses. 2019 administrative expenses adjusted for over depreciation. Over depreciation 14. So you adjust over depreciation 14. You need to deduct the depreciation expense. So you have to deduct the depreciation expense. You have to reduce the depreciation expense. So what happens is administrative expenses reduces. How much? Adjusted value 1728. Adjusted value 1728. Then 2020. So you have to adjust for over depreciation 13. So you have to adjust for over depreciation 13. 2020 over depreciation 13. Then your expenses reduces. Now it is 2175. So this should be reduced by another 13. You see 2162. 2,162. So you see, after the adjustment, you see all 3 years, depreciations are on the same basis. So after the adjustments, all the 3 years, depreciations are on the same basis. Right. So the same over depreciation, you have to adjust to the asset value. You have to adjust to the asset value. 2019, 14, 2020, 13. So let's see 2019 property, plant and equipment. So you have to adjust over depreciation. 14. You have to adjust over depreciation 14. Then what happens? You reduce the depreciation expense, then asset value goes up. So asset value increases by 14. Asset value increases by 14. Then 2020. 2020. So this 1,200 is the lease. This 1,200 is the lease asset. You can write down lease asset. Lease asset. $1,200. Then you have to adjust the over depreciation. Over depreciation 13. Then asset value goes up by 13. Asset value goes up by 13. Any questions? Now you have to work out this question by yourself. That's why I have asked you to come with the answers. Right. So if you have the answers now, you could have checked and see your mistakes. This is how you can learn, right? So I'm not giving this Excel worksheet. You have to work by yourself. So if there's any question, you can ask. Right. If there's any question, you can ask. You have to work by yourself. Right. Now we have done all the adjustments. Right. Now you get the adjusted values. So we'll take adjusted values for 2021. Sales, there's no adjustment. Cost of sales, there's no adjustment. Then the gross profit is the same. Gross profit is the same. So we'll calculate the adjusted values for 2021. Right. 2021. Right. Gross profit same. There is no adjustment to interest received. That's same. No adjustment to distribution expenses. It's same. Then how much profit before tax? How much profit before tax? Gross profit plus interest received minus your expenses. Minus your expenses. You see profit before tax, $1,931. Now see whether you have profit before tax 1,931 after all these adjustments. Now you see before the adjustment, profit before tax 2,418. After the adjustment, profit before tax 1,931. Now you see profit before tax reduces by how much? You calculate the change in the profit before tax. Before the adjustment, it was 2,418. After the adjustment, it's 1,931. You see profit before tax reduces by 487. Profit before tax reduces by 487. So when that reduces, your tax expense reduces. So when the profit before tax reduces, your tax expense reduces. Now you can calculate the tax effect. You can remember we studied last time. We studied last time how to get the tax effect. You calculate the effective tax rate. Effective tax rate. So how do you calculate effective tax rate? Tax expense divided by profit before tax. Tax expense divided by profit before tax. Now you see effective tax rate 30%. Effective tax rate 30%. Now you see your profit before tax decreases by 487. As a result, the tax expense should decrease. So how do you calculate? How do you calculate the decrease in the tax expense? The change in the profit multiplied by effective tax rate. The change in the profit multiplied by effective tax rate. So your tax expense decreases by, you see, 146. Tax expense decreases by 146. So change in the profit before tax multiplied by effective tax rate. Then 2021, revised income tax. Revised income tax 579. 579. Before adjustment 725. So it reduces by 146. Then the revised income tax 579. Then you can calculate the profit for the year. You can calculate profit for the year. $1,352 profit for the year. 1,352. Then how much net change in the profit? How much net change in the profit? Before adjustment, it's 1,693. After adjustment, that reduces to 1,352. You see net change in the profit. Net change in the profit, 341. The net change in the profit for the year, 341. So you have to adjust this to retained earnings. So profit for the year reduces by 341. As a result, retained earnings reduces by 341. So your retained earnings reduces by 341. Before adjustment, the retained earnings 3,810. So that reduces by 341. Then adjusted retained earnings 3,469. Adjusted retained earnings 3,469. So these points we studied last time. So there is nothing new. We have already studied. Then we can take the rest of the values. Intangible assets, there's no change. Current assets, you see values are same as before adjustments. There are no adjustment to the current assets. There are no adjustment to the current assets. Then you can take the total assets. You can take the total assets. Total assets, 17,522. Total assets, 17,522. Stated capital, same as before. Loans, we have adjusted debentures, creditors, lease creditors. We got the adjusted values. Trade creditors, there is no adjustment. The adjusted value is 974. Tax payable. Now here there is an adjustment. Now if you see again income statement, you see tax expense reduces by 146. You see, tax expense reduces by 146. As a result, your tax payable reduces by 146. So you know this, when the tax payable reduces, when the tax expense reduces, your tax payable reduces. Then adjusted tax payable, adjusted tax payable 86. Adjusted tax payable 86. Accrued expenses same as before. Now you can take the total equity and liabilities. You can take the total equity and liabilities. It's 17,606. Now total assets 17,522. Equity and liabilities 17,606. So these two are not necessarily be equal because we have not passed any double entries. So we have done some adjustment to make the financial statement suitable for the analysis. You can see how much the difference. Sometimes we have missed some adjustments. how much difference between total assets and equity and liabilities? 84. 84. You can check whether we miss some adjustments. You can check whether we might have missed some adjustments. Right. Right. So you can check again the adjustments and see whether you might have missed some adjustments. Right. But remember, for your analysis, these two are not necessarily be equal. Because here we don't pass any double entries. So we have adjusted our financial statement to make the values suitable for the analysis. Right. So our purpose is to make the values more suitable for the analysis. Right. So similarly, you can complete the adjusted values for 2020 and 2019. Right. You can complete the adjusted value column for 2020 and 2019. Then after the adjustments, so after getting the adjusted values, so you are doing the analysis based on those adjusted values. So after completing this accounting analysis, so you are going to complete the analysis. You are going to do the analysis based on these adjusted values. Based on these adjusted values. Right. Now you should do this by yourself. Now, if you have any questions, we can discuss next time. So I'm not going to give this work Excel sheet. You have to do it by yourself. Right. Then only you get to know about these adjustments. Now do this by yourself. So if you have any questions, you can ask next time. Right. So we can discuss your questions next time. Now during this week, you have to do this by yourself. So while doing this, you will get to know about the accounting standards, especially IFRS 16 leases and IFRS 9. In addition, you get to know how to adjust financial statements without passing any double entries. Now, practically, to adjust, when you do some adjustment to financial statement for various purposes, you don't pass double entries. You should be able to adjust financial statement itself without passing any double entries. So you should be able to think financial effects of the adjustments. Accordingly, you should be able to adjust the financial statements. So you will get that experience with this tutorial. Right. Now you see there you will have a lot of learning. So you can have this learning only if you do this by yourself. Otherwise, you don't get anything. Right. So do this by yourself during this week. Next time we can discuss your questions. Right. Then see you next time.
Thank you, sir.
Thank you, sir.
You're welcome.
Thank you, sir.